The Minority Market. Episode 13. Why protecting capital comes before seeking profits. Most people enter the stock market with one dominant thought: making money. Profits become the only visible goal. Charts, news, tips, strategies, and predictions are all filtered through a single question: how much can I make? This mindset feels logical, even necessary. But it is also the exact reason why most market participants fail. Before profits, before growth, before compounding, survival comes first. And survival in markets depends on one thing above all else: protecting capital. Capital is your oxygen. Without it, you cannot participate. Without it, no strategy works, no mindset matters, and no learning continues. Yet beginners treat capital casually, assuming it can always be rebuilt. They focus on upside while ignoring downside. The minority understands a harsh truth: profits are optional in the short term, but capital protection is mandatory at all times. The market does not reward ambition, it rewards discipline. When you focus only on profits, you subconsciously accept excessive risk. You justify poor decisions because of potential gains. You stay in bad trades hoping they will turn around. You overtrade to recover losses. Each of these behaviors slowly erodes capital, not in one dramatic collapse, but through repeated small mistakes that compound negatively. Most people think losses are temporary and profits are permanent. Reality is the opposite. Profits vanish quickly when discipline breaks, but losses leave lasting damage. A 50% loss requires a 100% gain just to break even. A 70% loss requires more than 230%. This math alone explains why protecting capital is more important than chasing returns. The deeper the loss, the harder recovery becomes, both financially and psychologically. Capital protection is not just about numbers. It is about mental stability. Large losses distort thinking. Fear replaces logic. Confidence collapses. Decision-making becomes reactive instead of deliberate. Many traders quit not because they lacked intelligence, but because their capital and confidence was damaged beyond repair. The minority avoids this trap by designing every decision around survival first. Another dangerous illusion is the belief that opportunity is scarce. Beginners rush into trades because they fear missing out. They believe this is a rare chance, a once-in-a-lifetime move. This urgency pushes them to risk more than they should. The minority sees markets differently. Opportunities are endless, but capital is finite. Missing a trade costs nothing. Losing capital costs everything. Protecting capital does not mean avoiding risk entirely. Risk is unavoidable in markets, but risk must be controlled, measured, and accepted consciously. The minority risks small portions of capital on each decision. They assume they can be wrong. They design outcomes where mistakes are survivable. This humility is not weakness, it is strength. Most failures come from oversized positions. When too much capital is exposed to a single idea, emotions take control. Logic disappears. Rules are bent. Stop losses are ignored. The market then teaches its lesson brutally. The minority never allows a single idea to threaten their survival. No matter how confident they feel, position size remains disciplined. Another critical aspect of capital protection is patience. Doing nothing is often the most protective action. Beginners feel unproductive when they are not trading or investing. They confuse activity with progress. The minority understands that waiting is part of the process. Capital preserved during uncertain conditions becomes powerful during clarity. Cash is not weakness, it is optionality. Protecting capital also means accepting small losses quickly. This is emotionally difficult. Ego resists admitting mistakes. Hope whispers that price will return. But small losses are fees for participation. They are manageable, recoverable, and educational. Large losses are destructive. The minority trains themselves to respect small losses and fear large ones, the opposite of the majority. There is also a long-term dimension to capital protection. Compounding works only when capital remains intact. Even modest returns, when combined with consistent protection, grow significantly over time. High returns with poor risk control eventually collapse. History repeatedly shows that steady survivors outperform aggressive gamblers. Ask yourself a simple question before every decision. If this goes wrong, will I still be able to continue? If the answer is no, the risk is too high. This single filter eliminates most destructive behavior. The minority applies this question instinctively, not emotionally. Capital protection is not glamorous. It doesn't produce exciting stories or quick wins. It produces longevity, and longevity is the real advantage in markets. The longer you stay disciplined, solvent, and emotionally stable, the greater your probability of success becomes. To start practicing capital protection, begin with awareness. Track how much you risk, not how much you hope to gain. Reduce position sizes. Accept boredom. Respect uncertainty. Treat capital as irreplaceable, even if it is not. This mindset shift alone separates the minority from the majority. Remember this principle clearly. Profits are a byproduct of survival, not the objective that comes first. Those who chase profits without protecting capital eventually lose both. Those who protect capital patiently give themselves the only real edge that matters: time. In the market, time is power. Capital buys time. Protect it relentlessly.